Ladies and gentlemen, thanks for tuning into The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block, and we're very excited today to be joined. You heard his voice on the other side of the mic, Jake Bruckman of CoinFund. Sir, I'm sure most listeners are very familiar with the firm, but before maybe we can talk about ChatGPT-4's announcement today and the intersection of crypto and AI, because we haven't done that in a while. But first, maybe for listeners who live under the proverbial rock, tell us about CoinFund as a firm. I was speaking with a friend before, and you guys are difficult as a podcaster because there's too many notable people within the organization to interview. It makes it very difficult. Most firms, they have one or two or three. I think this might be you're the third partner to join the program.
Thanks, Frank. First of all, thank you so much for having me. It's my pleasure to be here, and thank you for saying that. We have 5 managing partners at CoinFund, and they come at the problem from their deep expertise in their areas, and it's a multidisciplinary team. So I'm not surprised that you've had a number of them on here talking about different topics. What would you like to know about CoinFund?
So maybe walk us through sort of the, how should people think of it, right? I mean, I know there's a liquid aspect. There's also the venture component. I remember one time we were speaking on a rooftop and you were talking about how you wanted to build almost this platform, right, for crypto investment. What does that platform look like for folks who are maybe unfamiliar?
So let me give you like a super quick history, which is that I founded CoinFund in 2015. So we're about to be 9 years of full-time investing in the crypto and blockchain space. That's exciting. We started as like really just a few very crypto interested individuals coming together to study the space. And we're probably one of the earliest kind of like crypto fund experiments in the space. Fast forward to today, I would say we are a much bigger, we're about a 30-person institutional grade firm. We're regulated, we're an RIA. We have, hundreds of professional LPs, with the vast majority of them being now institutional LPs. And what is it that our founders should know? As a crypto fund, we are a pretty technical fund. Like, I started the firm with this idea that I'm a technologist, right? I want to have a bottom-up functional understanding of the technology that we're investing in and why it's important, why it's good, why it's going to beat the competition, why it's going to be long-term successful. And secondly, we're a hands-on fund. We're not the kind of fund that says, okay, here's some money, like, thank you very much. We have a head of platform, Jenna Pilgrim. We have a head of comms and marketing, Jules Mosler, head of people, Margaret Gabriel, right? Our managing partners, our partners, and even our analysts work actively with our portfolio companies to bring them, to long-term success. And so technical and hands-on is how I would pitch to founders, and, extremely professional, institutional grade is how I would pitch to our LP base.
And walk us through the playbook, maybe. You sort of described this very much hands-on approach in dealing with portfolio companies. What are some of the other elements, and how has that evolved over the last nearly a decade, Jake? I hope that doesn't make you feel too old.
Makes me feel old. Well, look, I think most VCs in general will say that we're very value additive to our portfolio companies. At CoinFund, we try to codify that and live through that every day. Part of that is just having people who are dedicated to that enterprise and have the expectation that this is what we need to do. And part of it is like actually doing that work, right? And what does that work entail? It's a mixture of crypto-related sort of problems that we help to solve. And those problems could be thinking about the regulatory environment, thinking about token economics, thinking about how a particular technology fits into a certain project. And then it's a set of problems that sort of like all early stage tech has, which is, how do I hire a team? How do I position my company? How do I raise money? How do I go to market? What is the best strategy? And so on and so forth. And so we mix that together into like an active discipline. And as a matter of fact, our mission statement, which we've solidified over the last couple of years, is we champion the leaders of the new internet. And I really love that word champion, because it sort of conveys that we're backing them, we're facilitating them. We're not just betting on them, we're helping them succeed. But at the same time, it's not like overbearing, like we're micromanaging them, right? So I think champion is a really good word to describe.
Championing a champion versus a parent, I think, will
right
be a better way to describe the situation. This is important stuff right now. And correct me if I'm wrong, but this is what I'm hearing as a modest observer of the market, as in my capacity as a dedicated servant to our shareholders here at the block. I noticed that it feels right like the early stage venture crypto category is crowded to an extent. And so in order to get onto a cap table, you do need to illustrate the extent to which you can be additive on a number of different levels, whether it's from the technology, the tokenomics, to just human capital as well, just helping them find, the right type of developer talent, the right type of legal talent, the right type of marketing talent. Has it become increasingly difficult in this part of the cycle? Does it seem like there are the same number of venture folks chasing fewer deals? But I would add just one element first, just to clarify. I would say that the deals are higher quality, but maybe there are in aggregate fewer of them. Just to tack on as a appendix to the question.
Well, let me answer that by first taking a step back and sort of recognizing that crypto venture is like a part of a general tech venture market as a whole. I asked our head of venture investments, David Packman, what he thought about the general tech venture market, whether it is like really crowded and so forth. And his opinion was like, hey, that's a matter of opinion. But if you look at the stats, kind of starting in 2021, capital and venture overall, which means like seed, early stage, later stage investments, went from around like 300 billion raised per year in 2020 to around mid 400 billions raised per year every year since then. So like 21, 22, 23, and so forth. And so there's definitely like more capital in venture in general. Right. And of course, venture also has to look at crypto to some extent, or at least, form an opinion of it. What's interesting in venture, there's a lot of like what we in the fund industry call TVPI. What that means is essentially, paper profits, but very little DPI, which essentially means cash on cash returns, paid out to investors. And what's really cool about crypto is that in crypto, we actually get a lot more DPI because of this asset class. It's more liquid, right? So fund investors in crypto are happy because they generally get a lot more DPI in crypto than in general venture. Now, to your point about crypto specifically, well, I think my experience over the last 18 months or so is that there are indeed a lot of new emerging managers. I know that because on occasion
they want money.
they want money. It's been an exceptionally difficult environment, especially in 22 and 23 for an emerging manager in crypto to raise money. I think it's gotten a little bit better in the first half of 2024 here. And my experience, because I on occasion fund some emerging managers who I appreciate, is that there's been a number of them coming to market and starting to look at the pre-seed, seed stages of crypto. Now, I also think that at the same time, there's the crypto space is also like bigger than ever. I wish I had more or better metrics to share with you in the moment around how many companies there are, but I'm just giving you kind of like my impression that we see a substantial sort of increase overall if you look back a couple of years. So I think there's more money in general. There's more managers. I don't think like every manager has raised, but some have, and have done that successfully. And there's definitely like more entrepreneurs coming into the crypto space. So I just see this sort of as a natural progression in the growth of the industry.
I think that a component of that growth has happened over maybe not the last 18 months, but maybe past 3 to 4 years in the sort of growth sector. If you think about the outside of the early stage category, there are a number of companies from not just Ledger, Circle, and Coinbase, but also the likes of Sorare, Talos, or FalconX, or other growth stage protocols, right? Some of which have become growth stage in terms of valuation in the matter of a few months rather than a few years, as is typical, like Maker, Athena, or Lido, however you want to pronounce it. So this maybe the opportunity set that you're describing has increased overall, but maybe not for early stage. And I would contend, and maybe I'm wrong, that the sort of the growth stage and the liquid side of the market have less managers looking at them than the early stage.
Well, I think in that mid stage, like when I think about that stage, I think about our venture fund, which is again led by David. That's a $325 million fund, which we announced, I believe, last year. And then, between 23 and 24, I definitely think that the number of opportunities in that stage has increased. And when we say opportunities, we're thinking, like, from the perspective of that fund, we're thinking about companies that have sort of more maturity, right? They have more product market fit, they have more revenue, they have they're just sort of working. And I can tell you that, like, because we sort of keep an internal like whiff rate of like, are we seeing everything, right? The number of opportunities in that stage has increased for sure in 2024. And it's not just protocols, to your point, Frank. It's like, very traditional looking tech startups serving crypto as well. Like, Blockdaemon is in our portfolio.
Yeah.
That's an infrastructure as a service provider. Stuff like Chainalysis and so forth. So it does feel like crypto is maturing, and it is requiring sort of more quote unquote mid-stage entities. It's really just Series A and Series B. If you look at the traditional tech world, which is still technically considered early stage, but there's relatively few funds compared to the total crypto fund market who could, like, for example, lead a deal in that stage, right? Just given the kind of valuations and raise sizes that are happening, in those stages.
So that's potentially an opportunity maybe for CoinFund looking at leading or opportunities at the C/D stage.
Yeah, for sure. Actually, Regan Bosman had this awesome Twitter thread a few months ago where he was just looking at the crypto fund market, and one of the observations was that how many crypto funds in the space can write a $10 million check and lead like kind of a mid stage and deal, and the answer according to him was 11.
That's so funny because so that's so interesting to me, because if you actually, again, I'm going to go off my gut as well. I don't have data to support this, but when I think back to when we were printing crypto unicorns every other day back in 2021, a lot of the leads were not crypto funds per se. They were like, if I think of BlockFi, it was Valor, I want to say, for their Series C, or who led FTX? Was it? It wasn't Sequoia, was it? But they were on the cap table. And so for these larger deals, it wasn't necessarily the crypto funds at the top of the page there.
Right. Exactly.
And but does that change?
Well, I think it has changed because, like, in the crypto fund world, some of the funds have grown, right? There's been sort of successful investments, et cetera. There's been fundraising. Just speaking for ourselves, throughout 22 and 23, we actually raised about 550 million across all of our strategies. And by the way, sorry, I didn't fully answer your question before, because you asked like what are the different strategies at CoinFund. The strategies are, we have a seed fund. That's mainly where I'm doing my work. That's a $158 million fund, which we announced last summer. We have our Series A and B venture fund led by David that I referenced before. And we have a liquid fund, whose portfolio manager is Seth Gins, our head of liquid investments, who I'm sure you know. And so those are our three kind of core strategies. But given the sort of bigger venture fund, CoinFund becomes one of those 11 who can write a $10 million check and lead a deal. And I'm sure that number will increase. I'm sure the number of traditional VCs, has definitely been going up, right? As like Founders Fund and others have entered the space. I think for some reason, trad VC, like they kind of enter, and if things don't go that well, they sort of exit. Whereas like the crypto fund folks tend to be more, ideologically aligned, like
cockroaches. But so going back to what we were talking about before we turned on the mics, obviously AI becoming a more important category, and we can get into the firm's perspective on that.
Mm-hmm.
To what extent do these, I don't want to call them peripheral to crypto, but peripheral to how we understand crypto, in the sense of, the speculative environment where you're punting shit coins and yield farming. So AI, DePIN, telecommunications, these very much crypto segments that feel peripheral to people who sort of just live and breathe the more financial services element of it. Well, there's two questions. The first of which, to what extent will that make crypto more sticky for traditional investors, folks that already are investing in AI and IoT? They likely, won't want to miss out on these deals that are either crypto in the back and AI in the front, or vice versa. And I guess, so that's one point. And then the second point is, how do you see these opportunities? Do they make your job harder, right? Because it's not, I don't want to say that they're not crypto, but they're crypto plus something else. And so that probably requires a deeper level of understanding about AI. Are these new emerging categories turning crypto firms into generalist firms?
Well, that's a fantastic question.
Thank you. I finally got there. Jeez.
My answer to that question, Frank, is like, I am not surprised at all. Like there's like a group of people who say like crypto times whatever area, that's hype. To me, when I started CoinFund, I was looking at, Bitcoin back in 2013. And I was really asking the question of like, okay, I get that Bitcoin is, self-sovereign money, but my question is, what can blockchain technology actually be used for? What other applications does it have? So in other words, to me, it's very natural that we would kind of go around and apply Web3 primitives, blockchain primitives, crypto primitives, et cetera, incentives, et cetera, to different areas. And that's exactly what we have done. When we applied blockchain to finance, we got DeFi. When we applied blockchain, to digital art and collectibles, we got the NFT space. Now we're applying blockchain to AI. It's only natural. And to me, the main objection to that would be to say, well, hey, like blockchain is a technology in and of itself. It's like a consumer tech. I actually mostly don't believe that. I think mostly blockchain is an infrastructural technology, and most normal people don't need to know that they're operating on a blockchain, right? So to me, infrastructure is going to go around different areas and disrupt them. Now the question is, what is it doing for AI? Like why is AI kind of the intersection of AI and blockchain sort of an important topic now? My answer to that is, well, first of all, over the last couple of years, we've had, some incredible inflection points in the state of the art of AI. One of them actually potentially happened today, as OpenAI announced GPT 4.0 and kind of the voice mode around it, right? And people have now been putting their hands on AI. We're like 5 years ago, this was like not true at all. Like nobody in the mainstream world like ever played with AI ever for any reason. And what's becoming obvious after a couple of years of playing with this stuff is that, first of all, like all of our data is at risk. And we live in a world right now where, 3 to 5 companies on the West Coast of the United States are going to be in charge of, sort of like the AI, the way AI is created, presented, and distributed to everybody in the world. And that doesn't work for a lot of people. That doesn't work for governments who want to control it. It doesn't work for people who want their AI to perform and not be, sort of compromised by safety mechanisms. It doesn't work for people in different localities like India that have like a different cultural context, or Italy for that matter, right? And so there's a movement, I think, in open source that's saying, can we create AI, the AI pipeline that creates these models and products in an open way? And Web3 is one solution to that problem. Web3 will allow us to source compute. It will allow us to do decentralized open training. It will allow us to crowdfund, capital to train large models. It will allow us to inference models in a, scaled and efficient, cost-effective manner. And ultimately, it will allow, anyone who wants to work on AI and create a business around that globally.
And so effectively, in this world in which blockchain or Web3, to use your word, serves as this underpinning verification mechanism for, everything that sort of goes through artificial intelligence, does that then mean that every company building an AI in some form could be a potential investment or investment opportunity by CoinFund? Because ultimately they will need, if your thesis is correct, crypto to some extent to operate in a way that is high functioning. Where does the line get drawn?
It's a really interesting question. It's a spectrum, right? It's also like that kind of spectrum is also true of other areas in
Sure.
Not just AI, right? Like you have companies who specifically focus on, infrastructure for blockchain, and those are very clearly like blockchain companies. And then you have, I don't know, Dentist Coin or whatever, which is like some other business, but it's using crypto as an incentive to attract dentists and so on, right? And so the question is like, does that fall under the mandate of like a crypto fund? I think like we tend to draw our line where Web3 primitives are actually creating an advantage for these companies over like the traditional model. Like, so companies that are using Web3 primitives are going to be more successful and they're going to outcompete. So now let's bring that back into the AI context. What is everybody saying? Everybody's saying is that the large big tech companies have already won, the compute race. Like they already have the contracts, they already have the compute. They're the GPU rich, everybody else is the GPU poor, and there's no hope to sort of catch up. But I would say, well, actually, there is a way that open source could catch up and create models that are vastly larger than anything that like Google or OpenAI could eventually train. How do they do that? Well, to me, I think that would mean creating decentralized networks for AI training. It would mean probably getting closer to be able to train models on more commodity hardware. And there's a lot of research going on, in that area. And ultimately, that means building a computation network that has more power than anything that like Google or Amazon, could buy. And I do think that that's possible with Web3. We're not seeing that yet, but it is the way that open source would create an advantage over proprietary models.
It'll be nice to see if this potentially ushers us into a phase of crypto that is much less about speculation and more about products that people want to actually use that are non-crypto. Is it overly skeptical of me to suggest that, or to feel a bit upset that I didn't spend the past decade to a decade covering AI instead of crypto, given the extent to which crypto has barely penetrated the lives of regular people. Whereas, I mean, it only took a few months for ChatGPT to become part of the zeitgeist.
Well, again, I think these are very different technologies, right? I think AI is very much a retail sort of consumer proximate technology, right? I love to tell this story. I brought, I went to my grandma's house. She's 87 years old. She only speaks Russian, but she knows how to use an iPad. And I pulled up ChatGPT for her, and she was able to type in a question and like use ChatGPT, right? Like, this is an amazing product for normal people because it's incredibly interesting. Everyone wants to try it. You know, there's no learning curve. You just kind of like type and have a chat and talk to ChatGPT, and it's very clear what you're there to do. And you know, this is very different from blockchain. Blockchain has a much harder problem. Blockchain is infrastructure that needs to replace this gargantuan traditional legacy infrastructure that's already there, and everybody's incentives are generally against that, right? So the way that blockchain has to do that is that it has to show over time and sort of like by force that it is just more efficient, and it is like economically better for people to eventually switch to that infrastructure. And that's happening, but it's happening much slower than retail and mainstream people can try out AI products.
Yes, but that definitely sort of it speaks to your underpinning thesis that blockchain as an investment, the lion's share, is not something that consumers will ever think about, whereas everything basically tied to AI is consumer to some extent for folks. Blockchain, basically, I guess to a large degree, for blockchain, blockchain at its peak success is almost completely abstracted away from the user, whereas hopefully we know with AI when we are using it. So I guess that's maybe the dichotomy to draw.
It also represents the tokenization of, you know, basically like all assets in the world, and the replacement of all or most, like, you know, digital infrastructure in the world eventually, or at least the infrastructure by which we used to coordinate. So I do think that's an enormous opportunity. I think it's kind of hard to say, maybe like really long term, like, you know, is AI going to be bigger? Is like the infrastructure going to be bigger? My intuition is that like infra is going to be bigger than kind of consumer apps, but given the purview of how wide the purview of AI is, you know, maybe that's not true, but like we'll just have to see how that plays out. I think crypto is a very worthwhile bet to make, so I wouldn't beat yourself up about it, Frank.
Good. And I think that maybe we were a bit too harsh on our friends at Paradigm when those headlines came out that they were looking at AI. I think they got a lot of flack for that by pundits and revelers on crypto Twitter, because to an extent that's where we are, where this is increasingly becoming a big opportunity. How do you see it relative to DePIN? I feel like they're similar. They're similar to me because I don't understand both.
Well, I think DePIN is like a much smaller, like vastly smaller market today. I think why we should like DePIN though is, you know, it's actually in the category of crypto and blockchain products that are much easier to explain to investors and mainstream users, and they really highlight the value propositions very clearly. Like one of the original DePIN projects is LivePeer. You know, we've known it since 2016. We've been investors since 2018. LivePeer is a decentralized network for compute, and in particular, compute for video transcoding, and more recently, AI. Now, if you look at compute on LivePeer, you have this very, very clear advantage. You're getting transcoding compute that is like 10 times cheaper than what you can get on Amazon and elsewhere, right? And so there's like a very, very clear value proposition. When you look at stuff like Helium, right, the kind of another famous DePIN project, which I like a lot as well, you know, this is a demonstration that crypto token incentives can really help to bootstrap, you know, a global telecommunications network essentially, and that's something that, really couldn't be done before unless you had billions and billions of dollars worth of capital. Now you can do it through these kinds of token economics. And I think that has been an incredible demonstration of the power of crypto. It remains to be seen, like, can we get this, network operating and serving like a lot of customers? But for example, here in Miami, you can already get Helium Mobile for $5 a month and have sort of an alternative data plan on your phone if you need it. I think that's really cool. And finally, to mention one more company, in DePIN, DeMo is essentially a data union for electric vehicle data. Like, vehicles are becoming A, much more electric in general, and B, just much more computerized. So all of the data that your vehicle generates about its performance, its battery life, its distance travel, and so on and so forth, is now data that you can reclaim using DeMo. And then there's a market of sort of demand side companies that want to build products on the aggregations of those data, but now they have to pay the owners of the data to do it. And that's really the one of the North Stars of Web3 is like self-sovereign data and like fair compensation to users. So like, I love DePIN because even though it's small, it's really showcasing some of the best value propositions of Web3 and is getting some traction for real. It's not just a speculation like some other things in crypto.
Yes. It sort of harkens me back to the Haslan days of the ICO boom where they were trying to make everything, Uber, but blockchain. Or, oh, yes, there was also Dentacoin. Remember Dentacoin? Yes. How could we forget? So these are much more like they feel similar, but they're getting more to the heart of the problem. But they also have to balance, right, the technology with tokenomics. So, and getting that right, it's not just as simple as building a product people want to use. It's also about getting these tokenomics right, because
totally, if
you don't, right, like what does that mean? I actually asked this to one of your portfolio companies this morning, that's in the DePIN space, and I basically said, the product that they're building is effectively leveraging this technology to enhance, the efficacy of GPS, so that you get instead of the accuracy being within, I think 10 feet, it's within an inch, leveraging these decentralized systems. And it can be anything. But let's say you build that out perfectly, but the tokenomics are bad and the price, tanks. Can you have a great product with a token price that's not great? I don't know. I don't think so. But he said something funny. He basically said, well, yes, of course, but this wouldn't happen. But if Verizon's stock price went down 95%, you're going to have a lot of, maybe not retail users of the phone, move to AT&T, but probably some people who use it as a as a enterprise client would think about doing that. Mm-hmm. So it kind of basically makes these early startups have to sort of deal with the intensity of public markets at an early stage. Anyway, I'm going to get off my soapbox because there is again another question here, which is how do you help companies balance that, right? Balance sort of building a product that they want to see adored by the market, whilst also making sure that the token just is stable, I guess.
I mean, that's a really good question. Like the short answer is, like, we've had a lot of experience watching companies try different experiments in token economics. I mean, again, we've been around since 2015. We've sort of seen it all. We've seen inflationary models, deflationary models. One of the things, like, it really depends what you're doing, but like one of the pitfalls, for example, is, when you're trying to use token incentives to bootstrap the supply side of a network, right? You're trying to attract computation nodes or users, right? And one lesson has been learned, like, very, very clearly over the years, is that token incentives are really good for aggregating attention, but they're not that good at, creating retention. Like you can bring people's attention to your product, but then you actually have to give them something really, really useful that they want to use all the time.
Well, there's some excellent data on this. I think like the customer acquisition cost from an airdrop or liquidity farming, I'd have to pull it up, but it's like $5,000 per user or something, something insane.
Right. We've had other situations where tokens kind of would run up really speculatively, capture a lot of attention, but then sort of deflate and destroy like that whole value proposition for a network, and that's not good. And so like part of it is kind of having seen some of those pitfalls before and trying to think about ways of getting ahead of that. Part of it is trying to think of kind of more responsible, more long-term models, right? So a lot of people have experimented with longer lockups or even points, right? Points is a way of creating attention, but then also saying like, you have to be here for a while to get the actual reward. There's been networks who require users to perform, to be active on the network, to perform certain actions in order to get a reward, right? It's not just like handed out to anyone who will come along, right? And that tends to increase the effectiveness of a particular audience, like in terms of retention. So I don't know if like anyone has the magic formula, Frank, that has solved this. But it's definitely like a very interesting primitive that, again, I think creates certain advantages that traditional companies without this capability, can't always compete with. And that is what attracts us to it.
Fair enough. What about other categories? What else is exciting you right now?
Well, I spent a lot of 2023 in the intersection of AI and Web3, which we talked about. I think another really exciting area right now is interoperability. So, when I think back to 2013 or so, this is like, I don't know if you were around the crypto space back then, but this was a time when, when you ask the average sort of crypto native person what's going to happen, they're like, well, you just need the one blockchain. It's called Bitcoin, and everything's going to run on it in the future. And I was just sort of like, no, that's not how things work. I think there's going to be a huge proliferation of blockchains. I'm talking like thousands or even millions of them. Now, I think 10 years, 11 years later, we've seen a huge proliferation of blockchains. We've seen layer 1s and layer 2s and layer 3s and side chains and every combination of possible supply side blockchain technology that you could imagine. And the next leg is that it's going to be highly interoperated. Now, that was my 2013 thesis. And that second leg of interoperability is only really starting to happen now. Now, like I remember there was like one of the first bridges between blockchain was kind of the Bitcoin Ethereum bridge, which I saw in 2015, right? It was like, like right after Ethereum launched, Consensus had a project that was connecting these two blockchains. There's been a ton of innovation in that space. And where we are now is we're seeing sort of like intense-based interoperability networks, like zero knowledge based interoperability, like just new, like message passing. There's all these new paradigms that what they're poised to do is they're sort of going to abstract chains. It's like the term is chain abstraction, right? So if you're, for example, a developer writing smart contracts for the Ethereum virtual machine, for the EVM, your experience today, for the most part, is that you have to go and deploy your contract on every chain that is EVM where you want to be. And the problem with that is that it segments your state, and therefore like it segments your liquidity if you're, for example, an AMM like Uniswap or Balancer. But with EVM interoperability, the way it's being designed now, the future is that your state kind of lives in one place, and the way that people interact with that state can be from any EVM blockchain whatsoever. And so suddenly you're in a much more abstracted world where you could be on any EVM chain, but you still just have like one, liquidity pool. And that is like a huge unlock, I think, for, not just AMMs, but any application, that has state that is relevant to its functionality, right? So we've seen a lot of projects doing that. Just was speaking to Polygon Ag layer today. There's a project called Omni working on this. There's other projects that are doing it on the wallet level, where it's like, you have a crypto wallet that can hold Bitcoin, Ethereum, and Solana in one place, but now it's totally permissionless and trustless. And then when you sort of go to, let's say, Rarible to buy an NFT or something, that NFT might be in denominated, like the cost of that NFT is denominated in Ether, but you say, hey, I want to pay in Solana, and then the network figures it out for you underneath. They're like, okay, we're going to go like liquidate this Solana for $300, convert that to Ethereum, send it to the guy in Ethereum, and voila, you're done. And this is now happening almost instantly because of the scalability of the thing.
When a lot of those pipes are finished being built, I think we're going to look back to this time in crypto and just think, it won't be us, but it'll be people who come after us, and they'll think, how the hell did you guys live like this in squalor?
How did you manage your state across 15 blockchains and all that stuff? For sure,
so difficult. Let's maybe turn back to just the venture landscape. We didn't really touch on LP expectations and what that category looks like and how they're changing. And you can speak to this given how long you guys have been at it. So I'm sure that the profile has changed. But let's maybe talk about expectations. Does the introduction of an ETF, especially for if we were to ever have ETFs tied to Solana or Ethereum, that's got to change the expectation, right? Because especially for maybe some early managers, your benchmark now becomes a bit more difficult. You got to at least beat these funds that are now easily accessible to folks.
Well, so that's a good question, which is, how does the ETF kind of change things? Maybe let's spend a minute on like who the LPs are, which will help us analyze that, right? So
let's do it.
So, when we came out in sort of the first fund in 2015, early 2016, there was no professional, investors writing checks to crypto, like period. In 2018, the people who were writing checks to crypto funds were more like high net worth individuals, a lot of them working in the crypto space already. There were some VCs who couldn't do it directly, who decided to somehow managed to like create a fund investment in a crypto fund to get exposure to space early. And there were some very, very early like crypto native fund of funds. By 2021, I think this is when much more institutional adoption started to happen. Actually, it was like a funny story. Seth Gins joined us on Jan 1, 2020. He was like, when Bitcoin crosses the all-time high of 20,000 for the second time, that's when everyone will start writing checks. It turned out that in February of 2021, what made the investors write checks is NFTs going on Saturday Night Live. It like made them feel like that crypto is going mainstream. Finally, we got to get in, right? But even then, most of the kind of investors I would characterize as like high net worth and maybe like family offices. And then fast forward to today, I think it's much more professional. You're talking about, sovereign wealth funds. You're talking about pensions, also high net worth, also fund of funds, OCIOs, but like, generally speaking, much more sophisticated investors, much more institutional investors, and people who speak to 5 managers a week, and it's like their job, right? So for those kinds of people, I think the latest sort of view is, the ETF represents a slow but progressing regulatory normalization. It is essentially confirmatory. And I think there's still like a lot of skepticism in the traditional LP world. So crypto is kind of a non-consensus investment. So the traditional LPs that have gone in, they have this view that they're like non-consensus and also starting to be right because of things like the ETF passage. The much more important point about ETF, I think, though, is it just makes it so much more accessible, which means that traditional participants can now hold Bitcoin. And the more people in the world hold Bitcoin, the more that opens up the door, for further regulatory normalization, for compliance, and for, other ETFs, and eventually crypto custody by banks, and so on and so forth. So to me, like, the ETF was one of the most bullish things this year, and really, in a way opened up the current market that we're in. And I think it'll be kind of a slow progression toward, more normalization around it.
So it's definitely going to bring in more LPs. How does it maybe change their expectations for returns?
Well, I think it depends what your LPs are kind of looking at, right? If they are just sort of interested in cryptocurrency, then, they have this analysis of Bitcoin being kind of the highest returning asset in the world for many years. Like, I think there was a famous chart, right? For the last 11 years, there's only 2 years where Bitcoin didn't outperform like everything by a lot. So, that's kind of one class of investor, but another class of investor, think like fund of funds, right? They're just more interested in the venture view. And that's just kind of a longer term view. And the idea is that, again, you have bigger TVPIs, so like bigger paper returns, and higher DPIs, higher cash on cash returns, which makes crypto funds like a much more attractive venture style, type of investment versus traditional venture.
Understood. Okay, sir, to close things out, what do you think is underrated right now and overrated? I hope you prepared for this one.
Mm-hmm. I think supply side technology is a little bit overrated. I think, what I mean is like people building a new blockchain, people building a high speed blockchain on EVM, people parallelizing stuff. Like we've been just selling supply side to supply side people like for many years. I think having a fast, performant, secure blockchain is just table stakes. And table stakes is consensus. Like, to be a good investor in crypto, I think you have to find non-consensus and be right. So if you're investing in like fast blockchain, you're just in consensus. Underrated, I think, is things like Intense. I think people don't understand Intense. I think it's a certain architecture there that is not going away anytime soon. And I think this architecture creates some of the best experiences. I'll tell you more specifically what I mean. I love Across Protocol. Across Protocol is currently, I think it's done like $7.5 billion of volume between its inception a year and a half ago and now. It uses an Intense architecture to deliver cross-chain bridging of assets, which it does really fast and really cheap. And this is like why I'm in tech, right? To find the technologies that just really create so much efficiency that you can't help but, adopt it. And I think like Intense architectures are that.
Boom. There you go. Thank you so much for joining the program. Where can people find you if they want to find you? Where are you on the socials? And
so I am on Twitter at JBRUKH. I'm also on Farcaster, although less. And then CoinFund is coinfund.io is our website, and check out our blog.coinfund.io.
Awesome. Thank you so much for taking the time.
Thank you, Frank. Thanks for having us.
Of course.